Hi, Mark. How are you?
I'm doing well. How are you?
Very good, very good. I invited you today to this call because I get a lot of questions from people that know me or don't know me and find out that I'm in real estate that are very concerned about where the market is going. Some buyers are saying, well, let's wait until the market will collapse so we can take advantage of this process. And they all blame the interest rates and think in their minds, they kind of compare it to what happened in 2006 or 7 when the subprime hit the market.
Right.
So instead of me starting to really give my opinion about it, because I'm not full-time doing loans and I'm not even doing loans part-time, I thought that it would be a better idea to invite you to really answer these questions with
Mhm.
your experience. So can you share just a little bit about your background?
Sure. I've been doing loans since 1992. And back in 1992, the rates were still at 12, 13%. A few years prior to that, they're 15. Previous prior to that, they're 17, 18%. The rates, even though they're up now, are still very good. The main difference about the market today versus the 2006, 2007 is the economy, even though we have high inflation, is still much stronger. The loans that were done back then were a lot of the stated income, stated asset loans, where a lot of people were getting loans that shouldn't be getting loans or really couldn't afford getting loans. So they got loans that started off at 1% and it stayed
Mm-hmm.
at 1% for a year. And then by year two, year three, the rates back up to 4 and 5 that couldn't afford the payments, especially when the second year hit. So a lot of the booms through, I would say, starting from about 2004, 2005, with all the easier loans, financing that was on the market available, made a lot of people, uh, gave them the ability to get loans that shouldn't have. Nowadays, we're qualifying the same old-fashioned way as we were in 1992. The industry is much more conservative, and the market is nowhere nearly as volatile as it was back in the 2005, 6, and 7 range. So even though the Fed has been raising its rates, and over 30 years, I've seen the Fed raise lower, raise lower. There's cycles based on the economy. Right now the Fed has raised rates. They're expected to continue. The most recent rate hike a few weeks back was they raised it 3/4 of a point, where the federal funds rate, and I'll get into what that means, is around 1.5 to 1 3/4. It's expected at the next meeting around July 27th, they'll raise the rates another 3/4 of a point. And by the end of the year, when they meet another 3, 4 times, it's expected to raise the rates a quarter each time. So by the end of the year, the federal funds rate is expected to be around 3 1/4. Now, what does all of this mean? The Feds, their main job is to control the monetary policy. They make the money easier to borrow or difficult to borrow. They raise the rates, lower the rates. So when banks, all saving institutions, they have their monies, excess monies for reserves to lend out. The Feds will set the rate that the banks will loan each other overnight rate. So the bad thing for interest rates is when the federal funds rates go up, we do eventually see mortgage rates go up. They're not directly tied like the credit card debt, home equity lines of credit, car loans, but eventually the mortgages do catch up. One good thing to take away is as the federal funds rates go up, also the rates returns that people get on CDs and depository accounts, we see those rates going back up. Back in the early mid 90s, interest rates that you can get on a savings account were, 4 or 5%. Nowadays, everything's pretty much under 1%. So there's a little balance act, but overall, I'm expecting interest rates to probably go up to a range of maybe 6 to 7% within the next year. Now, in the Bay Area, the economy is still strong. It's a little different market than the rest of the country because of all the high-tech companies and supporting industries. So when I look at, when I'm pre-qualifying my clients and doing the loans, whether the rate's at 4% or 7%, they could still afford to buy the home that they are. Now, the rest of the country, where the earnings are not quite as strong, they're maybe making 15, 20 bucks an hour, they'll feel the impact more, and those markets will correct. And how do they correct? Housing values will dip down a little bit to make it more affordable for people to come in. When the economy comes back again, we see the house values go back up again. So when I look at where homes were back in 92, they boomed up. And then at the end of the 90s, they came down a little bit, went back up in the early 2000s. They came back down a little bit during the financial collapse of 2006-07, and they went back up. But when you look over the long term, that line is just going up. And the housing market over the long term, in my opinion, is remaining very, very strong across the country, especially in the Bay Area. It doesn't really matter so much in the Bay Area market, whether the rate's at 5, 6, or 7%. It's still a great opportunity to buy a home. You have a good tax write-off, and over the long term, great investment returns. And the rates will get better, probably, who knows when, but my guess is within the next 2 to 3 years, based on typical cycles, and great opportunity to refinance and get that lower rate back in line and lower your monthly payments. So.
Yeah, many of my clients are from Israel because that's where I'm from. So in Israel, the mechanism is completely different. And here, there is a reason why many people don't choose the 30 years fixed. And that's mainly because people are refinancing. And so, the way that I explain to people is, yes, there is some softening in the market today because some buyers are out of the market from different reasons. And that's exactly why the people that can afford should get in, because they can get a house without so much competition. And then in a few years they can refinance and bring their monthly payments to a lower, more reasonable level. So, and we were talking also about investment. You shared with me before we started this official call that for yourself, you're looking for some investment opportunities in areas that are more volatile, because it's areas where typically people are investing money, like second homes and income properties. So for for the people that are in the audience that are looking for investment opportunities, we're going to talk about this topic differently. So for them, they might want to wait a little bit to see some more decline in the housing market and get better opportunities to buy. But at the same time, they have to remember the market will go down because buyers will go out of the market, which means that most likely they will go out because of two reasons. The main reason is probably that their buying power is going to be to decline because interest rates will go up.
Right.
So yes, you're waiting. You're going to get a property for less, but on your monthly, at least for now, you're going to pay a little bit more because the interest rates will go up. So it's kind of I think that the right timing is very personal at the end of the day. If you can afford, and plus, taking you back to the Bay Area, people have to live somewhere. And with my experience in property management, I can tell you that my phone can't stop ringing now because I have a few properties that are on the market to find new renters. It's crazy. The rental market is like crazy. So if people are postponing buying, they're going to pay more in rent anyway. Yep. So it's just, a decision that, everybody should make for themselves. But to kind of summarize what you said, you also don't believe that this is anywhere close to what happened in the last declining market, which is
Right.
2006-7, because the reason is different, right, Mark?
Yes.
And
Yeah.
plus, back then, from what I heard, it was super hard. After the bank collapsed, it was super hard to even be able to get a loan. So even for those
Mhm.
that could buy, they had to pay cash because it was impossible to get a loan. And now the banks are doing well. So, if somebody can qualify, they can get a loan. So it's a
Yeah.
very, very different market.
Right. One thing I stress with my clients when they're looking for their primary residence, they have their favorite neighborhoods they want to be in. And sometimes these neighborhoods have very low turnovers. If something does come up in the neighborhood that you really love, I recommend getting it now while the opportunity is there, because the rates could come down in a year or two. And it might be 2, 3 years before a home on that in those neighborhoods come up that you like. And if one
Mhm.
does come up that you like, does it have the proper bedroom bath count? So it does become more difficult when you're looking for specific neighborhoods, specific size. At that point, in my opinion, the rate's not important, but it's securing the areas that you want for the school districts, et cetera. There's opportunity to refinance, in the short term. But the main point is you're in the game, you got the property instead of paying high rents, waiting a year or two. And when the market does get stronger, the economy does get stronger, then the buyers are out there facing a lot of competition with other
Mhm.
buyers. So then we
That's
start
true.
seeing, like last year, the prior years, 15, 20 offers, values going up dramatically. I prefer my clients to get in the property now and build that equity over the next 2, 3 years
Mhm.
instead of wasting money on rent and then refinance. But then when the market does get better, inflation gets back down to 5%, 4%, and well, in time, you're going to see the rates coming back down. And just to get the neighborhood, the school district, what you're looking for now
Mhm.
is keen in overall strategies for maximizing the housing benefits for your family.
Yeah, and then that also brings me to talk about one of the other reasons that the Bay Area is so solid in terms of the housing market is the fact that everywhere else in the country you see a dramatic increase in inventory. You don't see that in the Bay Area. We see a
No,
slightly, improvement of inventory, but it's not even close to satisfy the level of demand. So
yeah,
when inventory stay low, it pretty much keeps the market from falling, and that's what I
yeah,
see here.
yeah. They're
So
not building more single family residences in
they're
your
not.
your core Santa Clara County or Silicon Valley. There's only so much, and if you need that single family residence with a yard, inventory is very low.
Absolutely. And all the new developments, or most of them, are just building, no lots properties. Even the single family homes, what they call single family homes, are like zero lot line. So I think that even the more they will build, your property with a little land around it is going to be worth more because it will
It
become
is.
kind of a rare find.
Yes.
So with that, Mark, I really want to thank you for this call, and we're going to record more tips about the market and more updates in the future.
Mhm.
And maybe sometimes the end of the summer, we will even put together a live seminar here in the Bay Area.
Yes, that would be
For those
nice.
of you, for those of you that want to mingle with other people and kind of hear the real truth about what's going on without all the interpretation and your friends' ideas and opinions. I think that it's always recommended to seek advice from people that that's what they do for a living. And Mark is one of the best loan agents that I know.
Thank
So
you.
You're very welcome. So thank you, Mark, and we're definitely going to talk soon.
Great. Thank you. Bye-bye.
You're welcome.